This is the fourth quarter update for the Amplify Seymour Cannabis ETF, symbol CNBS. I'm speaking with Tim Seymour. Tim, let's jump right in. What has your attention today as we're recording in January of 2024 in the cannabis space?
It's a combination of the macro, the bottom up, call them the earnings profile of the companies, and frankly, the positioning and the sentiment in the markets are all have an interesting alignment. We've had bull markets, we've had some pretty big bear markets in the cannabis space. We've had dynamics where we were overly excited about potential change on regulation and legalization. And we've had the opposite of that. We've had those moments where the companies themselves as operators have gone through periods where they've seen expansion in terms of their margin profiles and clearly a growing top line, which has always been the case in cannabis. The market gets bigger and bigger. But what I see as we open the year, I think there's a lot of optimism around some of the macro forces. We'll talk a second more about it. But I think what's important for cannabis investors is how much balance is there around that. Are these headlines that people are, as they say in the investment world, if you're ever investing alongside or reliant upon the government, you're in trouble. And cannabis has understood that over the last few years. But meanwhile, the companies themselves have put their heads down and through some difficult capital markets over the last 18 months, have found a way to be more profitable than they've ever been, more disciplined and rational in terms of both how they're growing or not growing their business, but focusing on core operations. And then again, back to the macro, there are a couple headlines that I think are ones that don't require the follow through from a legislative process in Congress, which, pick your sector, pick your issue, pick your side of the aisle. It doesn't matter. We all know getting stuff done in DC is almost impossible. So the headlines around rescheduling cannabis from a Schedule I drug to a Schedule III drug are more than headlines. There's been a letter written by the Health and Human Services, a recommendation to actually bring it down from a Schedule I. And for the audience that doesn't understand a lot of these dynamics, simply Schedule I drugs in the United States are drugs that have no medicinal value and are actually both taxed punitively and obviously have very limited scope to where they can be distributed. We're talking about LSD, we're talking about cocaine. So the fact that the Health and Human Services has in the last, it's really over the last 14 or 15 months, put the FDA to work. They released a 250-page report. This is the FDA really going through the science of cannabis and going through the efficacy dynamics around medicinal value and also probability of abuse and those dynamics. And the message very clearly out of a 250-page FDA document that was along with the HHS sent to the DEA in support of a rescheduling is, it was almost even a mea culpa. It was kind of, hey, we've been wrong about cannabis, and we've been wrong, and there's a lot of politics around cannabis and its history in this country. So, we could talk for a long time about those contents, but you asked about how we sit here as we look at the first quarter of 24. Cannabis investors have been through so many irrational up cycles that were based upon one or two headlines that weren't real. The fact is, there's real stuff going on here that I don't think necessarily has people disproportionately enthusiastic. The stocks themselves, actually, after this news was announced in late August, and they had a typical 40 to 80 to 100% run over 2 or 3 weeks, the stocks, after pulling back, have actually now in the last 3 weeks gone through those levels. So the charts are very constructive here too, for an industry that I still think has limited capital that has really been allowed to invest in it. And that's a very good sign. The price action is very positive.
So I think it's important for investors to understand that this is an actively managed ETF here, Tim. Could you tell us a little bit about your process as you build out the portfolio?
Sure. Yeah, I think we're obviously looking to be invested across the sector. It's a cannabis ETF. It's an active strategy, which means we don't have to wait for quarterly or semi-annual rebalancing. If companies are re-rating, and there are a number of different drivers of re-rating in cannabis, we think we have the ability to kind of roll up our sleeves. It's a research-heavy process. It's about talking with management teams, reading research, being in the market, going to conferences, going to sites, going to locations, seeing how a lot of these businesses are run. Ultimately, my the ethos and the mission statement of CNBS is to be invested in the industry in a broad-based way, to have exposure to the industry that we have today and possibly where we think that industry is moving and where it's going to be tomorrow. What that means is still 60 to 70% of the top of the balance sheet of the portfolio are focused on the biggest cannabis companies in the world. They are US based. It doesn't mean that we're a US only fund. We're a global fund. And there have been different times when the world has seemed to be more open to growth and expansion. And there will be. And Europe has actually had some interesting headlines over the last couple of months. Canada, we all know, was really where a lot of the early days of this industry started, because they federalized before the US has even gotten there even today. So we are there to own the biggest players, but we're there to also own some of the ancillary parts of the industry. And that could also be, think about e-commerce, think about technology, think about software, think about banking, think about financial services. And even though some of those subsectors have restrictions on them because of the legal status, it's made for a pretty interesting opportunity. So we are a diversified strategy, but make no mistake, I want to have exposure to what I think are the biggest companies with the highest chance of growth and, frankly, the highest opportunity of profitability.
When you look back on the fourth quarter, what changes do you think investors should be aware of?
Again, I think the changes that are the macro changes, which are that there could be moments in the next 3 to 6 months where, if you change the tax profile so that cannabis companies are not, without getting too deep into, you don't need a CPA to understand the dynamics of cannabis companies are taxed without being able to subtract cost of goods sold. So really, it almost by definition makes a lot of these companies unprofitable. If they remove a Schedule 1 designation on the drug to Schedule 3, it means that cannabis companies will suddenly have enormous free cash flow. There's an argument that about $150 million right away would flow into the top 6 or 7 names based upon taxes payable that they would have. I mean, there's a significant tax burden that I think is part of what investors are getting excited about. But look, even without this, what we saw in third quarter numbers going into that fourth quarter, so numbers that we got in the fourth quarter, were that the industry, the profitability metrics were better than they had been probably in 8 to 10 quarters. So having worked through a lot of the headline inflation dynamics, having worked through higher cost of capital, having worked through a lot of these companies that may have grown too fast and had an asset footprint that needed to be reeled in. Profitability in third quarter, as shown in fourth quarter, I think we're going to see numbers that might even improve upon the third quarter. So the bottom-up story, company by company, on an operational level and on an earnings multiple basis, you're now able to make that argument that cannabis companies trade, roughly 7 to 8 times, 7 to 9 times EV to adjusted EBITDA. That's at a significant discount to consumer staples and a very significant discount to consumer discretionary sectors out there. So right now you have the top line growth. You're seeing the follow through on the multiples, even without Washington following through. So we're optimistic here. It's a combination of some alignment of a few different forces, including, again, the technicals in the market are pretty interesting here.
So, Tim, let's wrap up with a couple of individual stocks. So what are some names in the portfolio today that have your attention that investors should be aware of?
The first name that it's easy to talk about is Green Thumb, GTI, which is the largest position in the balance sheet. This is one of the largest multi-state operators in the U.S. with a core asset base in some of the biggest states and some of the most profitable states. So not just California and some of the bigger cannabis states, but places like New Jersey, places like Illinois, places even in the Northeast that I think are showing incredible profitability trends that necessarily haven't always been the case throughout all of the states. I think it's a well-run company. Most importantly, the price action of this company, really, it's had the best institutional sponsorship. It's a stock that actually has behaved the best during difficult times and has held its gains during periods where we've seen the market get very excited. So I talked about that period where the markets rocketed in early September because of these announcements out of the HHS to the DEA. A lot of the companies rallied and then pulled back 40, 50%. GTI pulled back with some of the market, but actually has extended and is traded even above those levels from back then. In other words, we're making higher highs, at least of this cycle. That's very encouraging. I look at a Curaleaf, which is also, at one point really was the largest in terms of an asset base. This is a company that in the fourth quarter listed on the Toronto Stock Exchange. That to me has also been a catalyst to opening up investment in this company to a broader base of institutional investors. And I often say that investing in cannabis for the high net worth and the self-directed and the ETF investors that are in the space now, you're in well in advance, I think, of a big institutional wall of capital. Curaleaf put themselves, along with TerrAscend, who did it 2 months earlier, also a significant core weighting in the portfolio, in a position where they're now much more institutionally investable. The Toronto Stock Exchange, late summer into the fall, pretty much said, we're open for business for these cannabis companies. And I would argue that the Toronto Stock Exchange and the TSX is probably one of the top 2 or 3 exchanges in the world. That's very good for investing here. Curaleaf, to me, is going to continue to re-rate there. I think they've done some smart things in terms of reeling in unprofitable business. And I think it's a company that you kind of have to watch. Some of the other top kind of 4 or 5 multi-state operators, Trulieve, which is, I think, also gone through a process of evaluating balance sheet dynamics, capital markets, trying to swap out high cost of capital debt and some pretty significant hurdles to get through in terms of refinancing. They've done a lot of that, and we've seen the stock outperform. So we're going to continue to I think, give investors exposure to what we think are the highest market cap names, but the names that also we think there is some opportunity to pick stocks in here, and that's what we're here to do.
Well, Tim, thank you so much for your time. Viewers, to learn more about CNBS, please visit cnbsetf.com. Thank you.
Thanks, Jeff. Thank you.